Right, so Morey covered off what a conventional mortgage is, but there's, and all of these changes that apply, we've been talking about high ratio. So the government mandated changes apply to things, the three different changes, the investments, the refinance, and the amount of down payment that's required. However, just because that only applies to 80% financing or more, so less than 20% down, there's actually a lot of banks that are going to follow those guidelines all the way down the road. So it doesn't matter if you've got 35, 40, 50% down, a lot of banks are still going to follow these new guidelines. And the reason is kind of complicated and involves how the banks raise their money in the markets and whatnot. But if they're going to be doing that, you can see that these changes, and there's a lot of lenders that are going to be following them, I'd say half or more. So it's going to have a lot of impact for any loan to value, even though the mandated change only applies to 20% down or less. So rental income changes. In Vancouver, this is huge because we've heard the percentage of properties, especially condo market, it's rentals. It's definitely the most dramatic change. And ironically, this one isn't even mandated. This is simply something that's come down through CMHC, and then all the other insurers have jumped on board with similar policies, not identical. So we have three different insurers we talked about. We're not going to get into the specifics of who does exactly what type of product. But I can say that rental income is treated far less favorably than it was in the past. Now, this includes rental income from multiple different sources. You've seen on purchases, you see mortgage helper, in-law suites, nanny suites, basement suites. It doesn't matter what you call it. If it's a secondary suite within the property that has a second kitchen and is bringing in revenue for that property, then that income is being treated far less favorably than it was. It used to be that you could take a certain percentage of that income, say 80% was the number, and we would go, okay, you've got $1,000 of rent, we've got $800 we're allowed to use, how much mortgage does that support? And the answer was like $180,000 or something. So right away the person qualified for $180,000 more just by virtue of having that suite in the property. Well, in Vancouver we've got the whole authorized, unauthorized suite issue, right? And if something's authorized, can we use it? If it's unauthorized, can we use it? And the answers vary from insurer to insurer. So that's something where the brokers have to know every one of the guidelines and every one of the rules for the different institutions. I want to give an example of how the new rules are going to take effect. We're going to use the same example, $60,000, average cost, clean credit, etc. So this is assuming a $1,000 basement suite, $680 to $515. So the old approval amount. In Vancouver, I mean, you picture East Vancouver. Almost every home has a basement suite. Picture Surrey, Delta, all these different areas. All these basement suites that we were previously able to bring into the mix, we can, but at a much lesser and more constricted treatment. That's a 24% decline in how, or reduction in how much somebody can qualify for based on that income. So 24% is going to translate into an effect on how many buyers can afford properties at a particular price. Now rental income, I was talking about suites there, but it comes from multiple sources. There's really three different ways. You've got your basement suite, but then you've got a pure rental property. You're living in your home, maybe you have a rental condo, and it's rented out. The third one is for somebody, and this is where this third one is really where the rules are murky, and it's going to be interesting to see how it plays out. When someone owns a home, especially a first-time home buyer, they own their property, they want to upgrade to a new property, but they don't want to sell the first one. Maybe they've been there 5 years, they've built up significant equity, perhaps the property can rent for a considerable amount, so they want to get out of that property and move into a home. In that circumstance, that is where the treatment of that income for the old property is not really clear. The reason being is they don't have it at this point in time. So if somebody has a pure rental property and they've had it for an extended period of time, the new rules actually favor the treatment of that income over all else, as long as the people are declaring it and paying tax on it. If you're not declaring it and paying tax on it, going forward, it'll be far, far harder to qualify. So people should be declaring it anyway, because then you can offset your interest costs on the mortgage. So it makes sense to declare it and bring it into the math, but a lot of people still aren't doing it. Is there any questions on the rental income or how this affects suites, unauthorized, or whatnot? Okay, and that's the rental income section. I'm going to pass over to Leah, who will cover off the self-employment.